Hi guys. Welcome to my YouTube channel. So before we get started, make sure to hit the like button, also subscribe to my channel. In this video, we will talk about how to use technical analysis to identify market entry and exit points. So make sure to watch the full video. Many investors analyze stocks based on their fundamentals, such as their revenue, valuation, or industry trends. But fundamental factors aren't always reflected in the market price. Technical analysis seeks to predict price movements by examining historical data, mainly price and volume. It helps traders and investors navigate the gap between intrinsic value and market price by leveraging techniques like statistical analysis and behavioral economics. Technical analysis helps guide traders to what is most likely to happen given past information. Most investors use both technical and fundamental analysis to make decisions. There are generally two different ways to approach technical analysis: the top-down approach and the bottom-up approach. Often, short-term traders will take a top-down approach and long-term investors will take a bottom-up approach. In addition to this, there are 5 core steps to getting started with technical analysis. The top-down approach is a macroeconomic analysis that looks at the overall economy before focusing on individual securities. A trader would first focus on economies, then sectors, and then companies in the case of stocks. Traders using this approach focus on short-term gains as opposed to long-term valuations. For example, a trader may be interested in stocks that broke out from their 50-day moving average as a buying opportunity. The bottom-up approach focuses on individual stocks as opposed to a macroeconomic view. It involves analyzing a stock that appears fundamentally interesting for potential entry and exit points. For example, an investor may find an undervalued stock in a downtrend and use technical analysis to identify a specific entry point when the stock could be bottoming out. They seek value in their decisions and intend to hold a long-term view of their trades. In addition to these considerations, different types of traders might prefer using different forms of technical analysis. Day traders might use simple trend lines and volume indicators to make decisions, while swing or position traders may prefer chart patterns and technical indicators. Traders developing automated algorithms may have entirely different requirements that use a combination of volume indicators and technical indicators to drive decision-making. The first step is to identify a strategy or develop a trading system. For example, a novice trader may decide to follow a moving average crossover strategy, where they will track 2 moving averages, 50-day and 200-day, on a particular stock price movement. For this strategy, if the short-term 50-day moving average goes above the long-term 200-day moving average, it indicates an upward price trend and generates a buy signal. The opposite is true for a sell signal. Not all stocks or securities will fit with the above strategy, which is ideal for highly liquid and volatile stocks instead of illiquid or stable stocks. Different stocks or contracts may also require different parameter choices. In this case, different moving averages like a 15-day and 50-day moving average. Get the right trading account that supports the selected type of security: egg, common stock, penny stock, futures, options, etc. It should offer the required functionality for tracking and monitoring the selected technical indicators while keeping costs low to avoid eating into profits. For the above strategy, a basic account with moving averages on candlestick charts would work. Traders may require different levels of functionality depending on their strategy. For example, day traders will require a margin account that provides access to level I quotes and market maker visibility. But for our example above, a basic account may be preferable as a lower cost option. There may be other features that are needed to maximize performance. Some traders may require mobile alerts or access to trading on the go, while others may leverage automated trading systems to execute trades on their behalf. Many investors leverage both fundamental and technical analysis when making investment decisions, since technical analysis helps fill in the gaps of knowledge. By developing an understanding of technical analysis, traders and investors can improve their long-term risk-adjusted returns, but it's important to understand and practice these techniques before committing real capital to avoid costly mistakes. Digital asset trading just got easier. With OKX, a leading digital asset financial service provider, you can access world-class security as you trade and store assets. What's more, You can win a mystery box worth up to $10,000 when you complete a deposit of more than $50 through a crypto purchase or top-up within 30 days of registration. Learn more and sign up to claim your mystery box today. Range-bound markets. Suitable entry points in range-bound markets are typically near key support and resistance levels. Using trend lines to connect peaks and troughs helps to define support and resistance areas on a chart. For instance, the chart below has a trading range between $22 and $27.5. A high probability entry point for a long trade would be near the support trend line, while a high probability entry point for a short position would be close to the resistance trend line. Investors who use this method for selecting an entry point may wait for a head fake move above or below a significant support or resistance level before taking a trade. Trade entries can be streamlined by using a strict set of rules. For example, an investor's trading strategy may only generate an entry point when a stock crosses its 200-day moving average and the moving average convergence-divergence signal line crosses zero. To automate the process further, entry points can be programmed into trading algorithms that automatically place trades when the conditions are met. Algorithms should also include exit points and risk management rules. Are you interested in developing skills related to banking, investment management, or other fields related to finance? Browse hundreds of online certificate programs the world's leading universities offer in partnership with Emeritus. From core fundamentals to the latest research studies, you'll find a range of courses taught by industry experts. Learn more about developing future-ready skills and get started. Suitable entry points in range-bound markets are typically near key support and resistance levels. Using trend lines to connect peaks and troughs helps to define support and resistance areas on a chart. For instance, the chart below has a trading range between $22 and $27.5. A high probability entry point for a long trade would be near the support trend line, while a high probability entry point for a short position would be close to the resistance trend line. Investors who use this method for selecting an entry point may wait for a head fake move above or below a significant support or resistance level before taking a trade. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.